here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing in finance. My name is Jason Rivera. Welcome to Value Investing in Your Car. Hey, Jason Rivera here. In this episode of Value Investing in Your Car, I'm going to tell you why value investors avoid IPOs by going over one of the most recent high-profile IPOs, Zoom Video Communications Inc., or ZM. Before we get to that, I need to tell you this podcast or this video series is now available as a podcast for free anywhere in the world, available on all major podcasting platforms for free in the world: iTunes, SoundCloud, Stitcher, Anchor, and more. Pretty much any free podcasting platform, this video content is now available as a podcast for free anywhere in the world. So, all right, let's get started. Hopefully you can see my other screen here. Okay, it looks like everything's working. So I always get the question anytime a new tech IPO comes out, are you going to invest in it? Whether it's Facebook, Twitter, LinkedIn, whatever it is. Anytime a new tech IPO comes out that a lot of people know about, I get asked, am I going to invest in it? Here, I'm going to perfectly illustrate why I never invest in IPOs. With Zoom, again, some context. I love this company's products. I'm using this company's product right now to record this video. I use Zoom to communicate with clients and potential clients and students from all over the world. I use Zoom instead of Skype because it's way better. It has way fewer technical issues, has more capabilities, is faster, and just in general, it's easier to use. So I love Zoom. Again, I use it almost every single day to meet with clients, students, potential clients, whatever, from all over the world. So I love the product. But I'm going to illustrate here why I won't invest in this IPO. Probably won't invest in this company for a very long time, if ever. So first thing you'll notice here is $68 per share. Hold on, let me see if my video is working. Make sure my video is working. Okay, there we go. You can see my face now. Okay, so 68.17 per share. It debuted on the market April 18th. So as of this recording, about 11 days ago, at $36 per share. And it's now valued in the stock market. And this isn't their entire, they didn't float their entire share count. They only released, I don't remember how many of the shares there were. Might talk about it in this article. But let's see. Okay, they sold 9.91 million shares in the IPO, but it doesn't say the total outstanding. So we're just gonna have to go with the information we have. So 68.17 per share, priced at, again, $36 per share at the start of trading on its IPO. So it's more than double in price. However, I'm still completely 100% glad I did not invest in the IPO. Here's why. Unlike most of the recent IPOs, or tech-related IPOs at least, this company is actually at least profitable on an operating margin basis, but its operating margin is less than 2%. So actually, before we go to that, let's finish talking about the valuation. So right now, the stock market values the entire company, or at least the publicly available shares, at $17.4 billion. Versus, and it only has an operating margin of 1.9% rounded up. So let's go to here to figure out what that means in kind of real world sense. Operating margin again, 1.9%. Off of $331 million in revenue, they've produced operating income, or EBIT. Remember, this is EBIT. This is what I use operating income to value and evaluate all of the businesses I evaluate. I never use net income or gross margin. I use operating income. So on $331 million in revenue, they've produced $6 million in operating income. Again, this is great for a new tech IPO because most of them are unprofitable completely. So, but what does this mean for the valuation of the company? So to illustrate this point, EV to EBIT is the metric I use to, I think it's far better than PE, which I think is useless. It tells you the full operations of the company, including cash and debt. And it tells you, and it uses EBIT, which again, I don't use net income. Earnings is the net income part of EV to EBIT because it's easily manipulatable. Operating income is far harder to manipulate, and it shows the actual income from the operations. So let's do a quick EV to EBIT calculation of this so I can illustrate this point for you. Okay, so we need, was it 17.4? 17.3 billion now, it just changed. So 17.3. Okay, so we can't do a full because they haven't, Morningstar doesn't have their numbers yet. Here. So let's see, that brings up nothing. So Morningstar must be still loading their data, so we're just going to do a market cap. Again, I don't like using just market cap, but we don't have the information here. And for the time savings, I don't want to go through their entire financials to find it. So I just want to illustrate this point here with this. So 17.3 divided by, oops, so right now, the company is selling at a market cap to EBIT of even higher than this, of 2,883. Again, if this was exactly EV to EBIT, this would likely be lower because of their cash and debt, but this still illustrates the point of why I will never likely invest in an IPO. While this company is profitable, unlike most of them, it's selling at 28, almost 2,900 times its, what, 20, it's trailing 12 month. It's trailing 12-month operating income. Oops, wrong button. Absolutely insane. In other words, so let's reverse that to find its earnings yield. Earnings yield is essentially the amount you should expect to earn owning the stock within the next year. So at this rate, hopefully you can see that. At current metrics, it would take, or you were expected to earn, so this was 0.003 0.010% owning the stock over the next year. That's insane. You earn more from banks, and banks, the rate of return is insane. So that essentially I don't even know how to quantify that. To earn a decent return, again, I deem a decent return 10 to 30%. That is 3/10,000ths of a percent that you're expected to earn on this stock in the next year. Again, I love their products. I use them. I'm using them right now. I use them almost every single day with clients, potential clients, students from all over the world. Great working product. Works a lot better than Skype. I love it. No way I would ever buy this stock right now. Not even, I would even ever consider it. It doesn't, and I could see the revenue. They were talking about revenue surging in the last 12 months somewhere. Somewhere in this article, they're talking about revenue surging. I don't care about revenue. If you're not profitable, you're not profitable. It doesn't matter how much revenue you're creating. You need to be profitable at some point. And again, this company is profitable, but according to its valuation, it's again selling at almost 2,900 times its 2019 or trailing 12-month operating income. For reference, I usually look for companies that are selling at a number below 8, not 2,900. That's the highest market cap to EBIT or EV to EBIT I've ever seen, to be honest. Insanely overvalued in my opinion, even though I love its products, love its services. Again, use them almost every single day. It's hopefully a perfect illustration of why value investors stay away from IPOs. Yes, we will be wrong on occasion over the long term on things like Google and Amazon and Facebook to a degree, but we'll also miss out on the massive mistakes as well. I explained this to some of my students last week, and I wanted to share these thoughts with you as well, because this is a super important point. Essentially, at this rate, you're worse than a coin flip trying to pick these companies. VCs who invest in these venture capitals who invest in these kind of entities as startups, they're doing great if they hit 1 out of 10 times. And they have to hope they bet big on the 1 time out of 10. So to me, it's more akin to gambling, investing in these kind of companies at the startup phase or even as they IPO. Again, I hope they work out for the long term. I hope people like Elon Musk fulfill his dreams of going to Mars and renewable energy and Hyperloop and changing transportation and all this stuff. From a technological and personal perspective, I hope they all succeed. From an investment perspective, this is where you have to separate things. You can't be emotional. Just because I love Zoom doesn't mean I'm going to invest in it. Just because I love what Elon Musk is doing doesn't mean I'm going to invest in his company. You have to be able to separate your mindset here. And this is hopefully a perfect illustration of why you have to do that and why value investors avoid IPOs. If you have any questions, comments, concerns, things I messed up, I would love to hear your thoughts on that. Think I'm crazy for missing out on things like Amazon, Facebook. And again, I'm perfectly happy missing out on these because I'll miss the bombs that go off as well. The ones you never hear about, the ones that go bankrupt. I'll miss out on those, and I'll miss out on Amazon and Facebook and Google. And I'm perfectly happy to do that. These companies will perpetually be overvalued the way I evaluate companies. And again, I'm perfectly happy with that. Because again, to me, it's more like gambling. You're hoping one of the 10 you pick is going to skyrocket, and you're hoping the other 9 don't lose you enough money to where you go illiquid or to where you go bankrupt before you are able to make any money off of the one. I hope this helps. I hope this makes sense. I'd love to hear your thoughts again, comments, questions, concerns. If you're watching on YouTube, make sure to like, love, share, and hit the notification bell so you're notified every time we release a new video. If you're listening on a podcast, thank you, and make sure love, share, all that stuff as well, and subscribe to the podcast. Thanks for watching. Hope you have a great day. Talk soon. Bye.